Hi, good afternoon, everyone. As Kajin has mentioned, this is our first webinar, and this is also my first time presenting without any physical audience around, but in the comfort of my own home. So in a way, this COVID-19 has actually brought about reality of embracing change to all of us. So today, my sharing cover mainly on three aspects: challenges faced by F&B industries in this COVID-19, immediate tasks and the strategies that companies can adopt, and how the company should develop capability to prepare for the future. We are in an unprecedented situation, and we are facing two major crises worldwide: health and economic crisis. So many F&B companies have been left scrambling to survive their business, adopt new strategies and technologies, and try their very best to keep their staff. However, bleak as it may sound, as Chinese saying goes, in every crisis, there is an opportunity. So what are the challenges do F&B face? We are faced with a continued fixed operating cost, which is high, while revenue has reduced drastically. Fixed operating costs such as rental costs, manpower costs, and there are some bank loans committed previously, equipment rental costs, and there are some tax payments yet to be made. So since the outbreak of COVID-19, sales has reduced substantially due to the decline in the tourism, social distancing measures, and circuit breakers. And now we have extended circuit breaker. Not only sales reduction and coupled with high fixed rental costs, for most of the restaurants, on-demand food delivery, once a very small percentage of their sales, has now become the key, or if not the only sales driver. It has become the only sales channel to keep the restaurant in operation nowadays. So the restaurants are facing challenges in managing and coordinating food preparations, food qualities, and delivery schedules with their riders. I'm pretty sure some of us probably will have encountered a long delay in the food delivery, which has affected the food quality when the food reached the customers. There are high merchant commissions, keen online sales competitions, and there are some restaurants even find themselves lack of funds or resources to revamp their websites or invest in the digital marketing to meet the demand for the online orders. The restaurant staff are also facing the risk of being infected. So the company will have to look into how they should plan their business continuity. Like any other industries, we have to live with the uncertainties of when the business or economy may recover. However, in the midst of all what's happening, it is very important that we still adopt a right perspective. First, we have to anticipate there will be a slow sales recovery. Negative GDP is expected, and we are in the recession. While working hard on exploring sales channels, it is needful for us to focus on preserving our cash and control costs at this moment. You will need to understand what is your cash position. How much do you have in the bank? How long can it last? And how much the bank is willing to loan you? And what's the possibility of the equity capital injections if it is required, whether it's from the shareholders or from your investors? Identify what is the funding debt. What is the amount of the money needed to fund the ongoing operations that is currently not available to you, and when you may need the cash injection? So start to explore different funding options available in the market early. So to preserve cash or for cost control purpose, you will need to review your operations. You may need to consolidate some resources, minimize costs, or if not lost. For example, the staff may need to multitasking or even temporarily close some of your outlets and consolidate online sales to certain outlets to lower the overall operating cost. Thirdly, you will need to evaluate your business model, assess and study if the current operating model serves well to support growth, meet the market demand, and continue to maximize the profit. It is important that your products and services are adaptable to changes. Fourthly, while it is hard to think of it now, it is also important to maintain the perspective to build your capability even in the midst of crisis, because it will provide you with a long-term competitive advantage. So the immediate tasks and the strategies should be focused on cash flow management. We're thankful that we have a government who has introduced various schemes to provide financial support to the companies. But I shall leave the details to Sean from SME Center to brief you on 24th, 2 days later. The government grants and support mainly help to address cash flow problems, such as rental rebate, rental waiver, co-fund the staff costs, like job support scheme or work-life grant, and to support the digital transformation through the product solution grant and EDG, and also build the capability through the EDG grant and MR8. There are also other government-assisted loans to help the company as they attempt to ride the COVID-19 crisis. Janus, our next speaker, will cover that in details later. So how shall the company manage its cash flow at this point of time? Careful manpower planning is needed because it's one of the major costs for the F&B. So I think many staff has been told or requested to take their annual leave or even no pay leave. And then some bosses has taken lead to take the pay cut of no pay. So you need to control the food costs and other operating costs, minimize wastage, and optimize your inventory. Inventory does have an impact on your cash flow. And I would like to highlight the job support scheme and foreign worker levy, because it can be a substantial sum for those companies with good numbers of locals and also some foreigners. And I suggest you actually do it. You forecast your cash inflow and do it for both for your profit and loss statement and for your cash flow, which means you accrue your salary subsidies in the respective month that's related to this rebate. And that will help to reflect a more accurate P&L performance for the respective month. So you won't get the short for the month you didn't get the cash in, but actually it's meant for the month to offset the month's staff costs. Also at the same time, monitor closely when the sum, which is paid out quarterly, that will be credited to your bank. And also confirm with your landlord on the period that you will receive your rental rebate. Some malls actually even return the partial rental deposit to the tenants. So please talk to your landlord if it's necessary. Confirm if the bank loan can be deferred if you require that, and also communicate with the bank. Make arrangement early with the bank if you foresee loan is needed. In fact, even you do not have a funding gap for that, given the low interest rate currently is offering in the market, it may be good for you to look into that, to take up some loans for your future expansion. I'll suggest you prepare a rolling cash flow forecast weekly, given the tight situation that we're in, and update the forecast on the weekly basis to reflect any changes. A rolling forecast actually serves as a plan, and it can be amended anytime, but it will make you on top of your cash flow status. So you can prepare a cash flow or prepare profit and loss by starting making some assumptions on your sales. You can use your last 2-3 weeks after the circuit breaker sales as a basis for your sales assumption and plan for good and bad scenarios. Find out what is the minimum cost that you will need to incur to achieve this sales. If you can't break even, then find out how long can you sustain the operation. Do take into consideration the support or the bank loans made available along the way. Make arrangement for your payment. Plan when to release payment with the suppliers. Is there any room for negotiation for later payment from your creditors? Or if you can make timely payments, is it possible to ask for discount on your payment? Now I would like to talk about online sales and food delivery. This has become an important sales channel in the F&B scene. In the past, much focus is on serving dine-in customers, and little attention is paid to online sales and delivery. We now need to view online business will gradually become as important as dine-in business. Therefore, careful planning of workflow and processes is needed. So first you review your food delivery menus to see if the menus meets the demand of your customers, whether it's price competitive, is it cost effective, taking into consideration of wastage or delivery cost, whether your menu offers variety of customers, or can you consider on the regular basis update your menu or change a new menu. Develop and monitor your sales. Find your online customers. Value add to your existing customers who are loyal to you in the past and even now. Compile and analyze sales data collected. Rank your sales menu, the items or the sets that's offered. That will be helpful for you to plan your marketing and plan your future menus. Assess the sales response from the respective online order platforms to assess the effectiveness of those platforms, and also try to explore other online platforms, other modes of deliveries, compare their commissions, fees, or take notes whether they are reliable and what is their payment terms. Also, it's important to monitor your margins. Try to compute the margin to have a good sense of the margin for each items or each set. And also prepare for the sales supply disruption. Understand there are some supplies, there's some shortage. So you might want to stock up more, but do consider the cash flow impact as well. And source for the cheaper options, alternate suppliers for the ingredients or other direct costs, maybe such as packaging costs. But be mindful of the qualities and the long-term relationship that you have built with your suppliers. So if you do consider go on other platforms, there are factors you may want to consider, which is the areas that they cover. Are they island-wide? What is the commission rate? Is there a boarding fee? Whether their software, the system reliable, their delivery is reliable, and what is their payment term to you? If you have to conduct online sales, you will have to have a digital presence and strong marketing digital marketing. Our other speakers, Benjamin and Eric, will be sharing with you more on the online sales next week. So we need to understand the COVID-19 crisis, however difficult, will one day go away. What will happen after that? We probably see a slow economic recovery, which will affect the consumer's spending power, higher demand for the value offerings. A strong focus on the delivery service will continue, and the strong focus on the online customer engagement. Food safety will be a concern, and with some F&B companies that likely not to survive this crisis, and we will see the loosening of the labor market, and more F&B space may make available for the rest. So looking forward, company, they see beyond COVID-19. One example is SIA and this group of company. They're planning the staff for training during this period. And this is to upskill their staff to prepare for the future. I know it might be difficult or too far for some of you to consider this at this point of time, but I hope that you put them in the back of your mind and think of it when things are more stable for you. So Companies need to develop capabilities to develop for the futures. There are 4 areas you might want to consider. First, evaluate the business model and build resilience. Review your current business model. Identify what are the gaps that you may need to fill, especially you have gone through this crisis, and design the changes. Also make sure that you execute these changes. Secondly, look at the workflow redesign. Invest in the automated equipment, invest in digital technologies. The government has pumped in a lot of grants to support in these areas. Enhance the manpower productivities, and also continue to focus on key service touchpoint and customer experience. Much we like to see a lot of technologies applied in the food and service sector, but it's still a service center. We still need to find appropriate service touchpoint for your customer that is effective. Thirdly, study the efficiency of the resources in the shared service in the areas such as central kitchen facilities. Can you share the central kitchen with others or share other central kitchen facilities? And also look at the back-end operations. Explore the outsource option for the back-end service, such as finance, HR, IT, or marketing. Outsourced shared service can prove to be cost-effective and strategically beneficial and useful. Expansion, as mentioned earlier, it is expected F&B space in the mall may be released due to the closure of some F&B operations. If you are looking to expand locally, this may be a good time to enter malls that previously you might consider too expensive to go into. For overseas expansions, you can consider various types of business model when venture overseas. Franchise, commonly used as a model to expand, and our speaker Albert, a franchise expert, will share with you in our last session on the 4th of May. As part of a capability development, financial forecast of 3 to 5 years is important for the company. It quantifies your plan and allows you to establish business goals that are both realistic and feasible. Financial forecasts help to predict the state of your business finance and give you the opportunities to measure the actual progress and anticipate potential problems if they arise. But I would suggest you be more proactive in doing your forecast. Set certain parameters upfront. For example, what is your expected growth rate? What is the desired sales mix? In this case, maybe dine-in as versus the online sales. What is the expected gross margins? What is the sales employee that you're expecting? So for you to budget your manpower cost. What is the sales per square foot? For you to make a sensible offer for the rental rate. Last but not the least, certainly is the profit margin. What is the reasonable margins for you to continue to stay in these operations? So with these 4 areas, evaluate your business model, study the efficiency of the resources, expansion plans, workflow redesign. It has the impact on how you prepare your forecast. I've come to my conclusion. So while we're facing many pressing issues with COVID-19, it is important not to lose sight of a longer-term perspective of your business. COVID-19 has brought many changes or challenges to F&B industries. I hope you can take stock of your business, find means to ride through this crisis. At the same time, identify new opportunities and thrive beyond this crisis. I'm certainly looking forward to see full house for F&B industries again. So with this said, I shall end my presentation. Thank you.
All right, thanks, Julia. We certainly hope full house will be full house very soon. Before I introduce the next speaker, Mr. Janus Lim, I'd like to reinforce again, this is actually a webinar. So at any one point, if any questions, please feel free to type in the Q&A box. Your questions will be there, I can see it. At the Q&A session, we will answer them one by one accordingly. So no worries, you can just type it in. Okay, so next, let's welcome Mr. Janus Lim from Finaqe.
Hello everyone, good afternoon, and thank you for taking time to come into today's webinar. I'm going to be sharing my screen. Okay, so for today, we're going to talk about how to increase your chances of getting a loan successfully. In general, this information applies, but it's more pressing, especially in view of COVID and its impact on businesses, especially in the F&B industry. And some of the challenges that businesses are facing now in terms of financing is whether operationally, can they still operate partially or are they shut completely? And this is a factor in which some lenders may consider, because then there'll be a breakage in terms of revenue and they may not approve financing unless the business is allowed to operate again, and then by which they would then assess the case again. So moving on. Sorry, just give me a minute. Okay, so today I want to touch about loan financing. And for those of you who had tried to apply for financing before, you may be aware that the process is opaque and your approval chances are unknown. And lenders typically do not review the reasons if your application is declined. So you cannot go online to search for how do I get a term loan from DBS successfully approved. You cannot search for this information because lenders do not review their credit parameters and their inner workings. So most of the time, we see very commonly businesses taking a reactive approach when it comes to financing. They tend to wait till their cash flow gets affected, or maybe an opportunity that has a short window. Then they start to move ahead to look at financing as an additional source of cash flow and working capital for them to solve whatever issues that they face. And one thing that businesses may not be aware is when you make an application, the lender randomly will assign an individual banker to assess your case. And there could be an instance where the banker that's assigned may be inexperienced. So every lender has their own parameters. And if you assign an inexperienced banker, which is unknown, it could be the luck of the draw, then it may be possible that your chances may be affected because this lender is not, this banker is not aware how to mitigate effectively. He or she may not be fully experienced with the credit process of the bank because they are new to the bank, and this may also impact your approval. So in terms of loan assessment, you undergo what we call as an underwriting process. This lets the bank assess the borrower's credit worthiness, and these criteria will vary across different lenders. For start, different lenders would have different industry preference, for example. Some lenders may be more familiar with particular industry. Some lenders may decide to lessen their exposure to certain industries because they may have some bad loans that has occurred for that particular industry, and they want to reduce the risk or the exposure to that particular industry. So they may not entertain applications for that industry if they decide to downsize their exposure to that industry. And what they will do is they will gather and analyze data from a variety of sources, some of which I will talk about in the next coming slides. And often we have had feedback that there is a gap between the loan amount applied and the amount approved. So although the lender may say it's up to say $300,000, how much you get approved for largely depends on your repayment ability. And we will talk about some of these details in terms of how to assess your repayment ability. So what is a term loan? Most SME owners would probably be quite familiar with a term loan, especially with the recent budget and the announcements of all this working capital loan, the bridging loan. It's a fixed loan which has specified repayment schedule, tenor between 1 to 5 years. So you pay principal plus interest on a monthly basis. depending on the tenor that you have signed up for. So how to increase your chances of getting a loan successfully? So one key factor is cash flow and proof of cash flow. Avoid having return checks in your bank account. Ensure that there are sufficient funds in your account when making payment. So what happens is that sometimes it's not necessarily a case of a lack of cash flow. We have heard many instances where some companies, for example, their admin person or their accounts person is on maternity leave or has left the company. So there's a gap. There is a person that is in charge of this area and that person is not available, for example. And typically, the SME owners are very busy with handling every other thing, right? So when it's time to make payment, for example, to suppliers or for your expenses, they may not be aware that funds coming in from their buyers may have been delayed, for example, and then they issue the payment to their supplier. So when a check is issued and there are insufficient funds, it will result in a return check. And this return check is characterized by the return check charge. There will be a charge that the bank will levy, say about $40 or $50, it ranges, to say that you try to issue a check for an amount that you do not have, it has bounced, and now you have to pay a return check service charge. So first and foremost, the banks typically do not entertain applications where the company has more than 2 return checks due to insufficient balance for the latest 6 months. This is an instant red flag, and unless we can prove that it is not a case of insufficient cash flow, it could just be an oversight, then there may be a chance to mitigate this issue. But if it is a cash flow issue and your balances are low at the end of each month, then this is a criteria that you would have missed and the bank may not approve the application. However, do take note that technical errors are not deemed as credit factors or issues. For example, if you sign wrongly, or if you date the check wrongly, or you wrote $100 in numerical form, but you wrote $200 in the word form, which results in the check being bounced. These are not credit issues. These do not point to your cash flow being insufficient. These are technical errors, and you will not incur a return check service charge for this. So look through and when you apply for financing, you typically need the latest 6 months operating bank statements to furnish. You need to look through your statements and ensure that there is no more than 2 return checks due to insufficient balance. Should there be, our advice is that you wait out that month in which that incident occurred and try to, where possible, keep your latest 6 months bank balance to be free of these 2 return checks. Next, you should ensure a healthy company's bank balance at the last day of each month. So it would be prudent to review your expense payment timing. A lot of companies pay their expenses at the end of the month. You know, the rental, the salaries, things like that. You know, it would be prudent to shift it to the start of the month. Why is this so? Because one of the criteria that banks look at is the ending bank balance on the last day of the month. So what they do is they will take 6 months balances, okay? Then they will calculate what's the average ending bank balance on the monthly basis. And one thing that's not in the slide that I would like to share here is that to give you an idea of how much financing you could possibly qualify for as a rule of thumb, is that your ending bank balance would typically indicate more or less your profit. And the banks would lend you based on a portion of your profit to calculate the repayment ability on a monthly basis. So for example, if you have 10,000 average ending balance at the end of your average 6 months bank balance, $10,000, you can take 25% as a safe percentage to make your monthly loan repayment. So for example, if the monthly loan repayment based on 25% would be $2,500, you could possibly look at a $100,000 loan over a 5-year tenor. Because a $100,000 loan at say 5% interest over a 5-year tenor would be $125,000. When you divide it by 60 months, that will give you about $2,200, which is the monthly installment. Then that would nicely fall within the 25% part of your average ending bank balance. And this figure is what they would extract from your bank balance statements, which is why it's prudent to shift all your expenses to the start of the month. They're not going to go into look into every transaction and to see your cash flow. They're just going to pick out that figure, add them all up, divide by 6. That will be your average ending bank balance. And then 25% would be a figure that you can look at as possible loan repayment amount that you can service. That will form part of your repayment ability. And from experience, it would be ideal where possible to have a 5-digit ending bank balance. That would give you possibly access to funding that's 50,000 and above, depending on what is your balance. So the strong bank balance indicates repayment ability. Next, maintain positive net worth. Net worth is your paid up capital plus your retained earnings. The paid up capital is the total amount of capital funded by your shareholders. And to the lenders, the paid up capital equates a level of commitment from shareholders. One thing that a lot of owners may not be aware of is that you could have 2 scenarios. You could have company A that has $1 paid up capital and 99,000 directors loan to company, for example. And you could have scenario B where you have 100,000 paid up. In both sense, the amount is the same, for example, 100,000, but the lenders would prefer to lend to companies in scenario B with 100,000 paid up. Because once the paid up has been registered, that is commitment from the shareholders that they are invested in the business. It has to go through that whole revenue, sales cycle, and profitability. In the end, it can draw its dividend. But when you lend the bulk of it to the company and you have a low payout, for example, there are instances where the bank may ask if you want to capitalize on that director's loan. The reason why is this, because when you lend to the company, you are on equal standing with the bank should they decide to finance your business. And in the event of a default and an event of liquidity, having to liquidate your company, you stand on the same rank as the bank. And then that will mean that the company may not have sufficient amount to repay the creditors, which in this case is you and the bank. So most of the time, the banks would prefer to see at least a positive net worth, a good paid up capital, which indicates commitment from the shareholders and the directors. The retained earnings are profits from the company less the dividends. So if companies do not draw out so much dividends and they leave it within the business, that contributes overall to a higher positive net worth. And then you would stand a higher chance of getting approvals. Next, which is a very, very key part of my presentation, you need to uphold and maintain a positive credit bureau score. Now, every one of us has a credit bureau score. You can go to creditbureau.com.sg. For $5, you can download your own credit bureau report. This is an important report for all business people because there is a lot of misperception that if the business is financially sound, it has good credit reputation, it will qualify for financing. That is not entirely true. The individual directors and shareholders credit bureau scores are equally, if not more important, because you are going to come in as the guarantor for the loan. And from the bank's perspective, if you are new to bank, they do not have any history or knowledge of your repayment ability or your repayment history because they have not financed your business before. The only indication that they would have first and foremost, in which they do their first layer of assessment, is character assessment. And they derive that by reviewing the guarantor's credit bureau score. So if your credit bureau score is, it will start from AA, BB, CC, and all the way down all the way to HHX, for example, for very worst case scenarios. If your credit scores are bad, below HH or GG, for example, it could be a deal breaker. The bank may say we will not lend to companies whose guarantors are below a certain rating, because this is an indication of their repayment habits. Not necessarily the repayment ability, but it could be repayment habits. For example, the scores would be reduced if you take on too much credit, or if you pay minimal sum on your credit cards, or if you don't make repayment and then there's debt restructuring, or you may be a discharge bankrupt. All these, which I will touch upon as I go on, are what would affect your score. So to get an idea, go to Credit Bureau, download your Credit Bureau report, and see your scores. And if the scores are not ideal, then you can take extra steps to try to improve the score, which I'll touch upon in my upcoming slides. Key point to note is that if your credit bureau fail, it's an instant decline for your loan application. They won't even move into assessing your business financial statements, because that is the first hurdle that you have to cross. So how do you build your personal credit reputation? Pay your bills on time. If there's late or missed payments on your credit facilities, personally, it lowers your credit rating. You should periodically check in every 6 months, for example, to review your own credit status. Pay in full where possible, because the payment history is an important factor in determining your credit score. Next, pay down your debts. Breathing space should have between the amount of debt reported on your total credit limits. That means if you had spent the last 6 months applying for 10 credit cards, that is often not a good indication. All this information is accessible by the banks. The banks are the only lenders mostly that has direct access to credit bureau, and that credit bureau is inbuilt into their algorithm for loan assessment. So they must extract the credit bureau and do the review, and their algorithm will calculate that if your credit bureau score is cut off to a certain point where you don't qualify, then the application is declined. Or they may delve deeper and look, or like this applicant has 10 credit cards and 5 credit lines, on the individual level, he has a few $100,000 of unsecured personal credit. So would the bank dare to take the risk to lend you additional loans, for example? Because if the company cannot pay, they would naturally go after the guarantor as a secondary source of repayment to reclaim the default. But if they see that the guarantor already has a mountain of debt, for example, then naturally that lowers your approval chances of getting the financing. So when you want to apply for financing, my personal advice is don't get seduced by the credit card with that miles and that cheap, F&B discounts. I mean, you can have 1 or 2 that you can use on a regular basis, but don't get seduced by the free luggage and stuff like that. Because every line that you take on, every credit card, every credit facility that you take on, whether you use or not, adds to your overall credit exposure. As far as the banks are concerned, you can have 10 credit cards, but maybe you actively use 1. You have another 9 that you don't use that amounts to a total of, say, 150,000. They will take the total credit limit exposure. They will not care whether you have used it or not, because the fact is that you can use it if you want, all at one go. That is the way that they access in terms of your credit exposure. So when you want to apply for credit cards or credit lines, try to ensure that there's a wider gap so that indicates your credit worthiness. If you are crazily applying for a lot of cards within a short period of time, that is often picked up by the lenders as well. Next, of course, limit the number of credit cards or credit lines. Opening up multiple credit lines reduces the credit worthiness. It also may impact your credit score, and it could indicate or signal excessive credit usage. Whether or not you use it, it doesn't matter. The credit limit is there. You can use it. Cancel any unused card, get the freebie, get the free gifts and stuff, the perks, then cancel it. Retain what is most frequently used and ensure that there is prompt payment history. Last but not least, where possible, although sometimes it's uncontrollable, is stay out of bankruptcy. This is one of the most, if not the most catastrophic effect on your credit status, and you'll be listed in the Singapore's bankruptcy register until you're discharged, which could be anything between a period of up to 7 to 10 years. And where possible, if you should unfortunately be faced with such a situation, request to restructure your debts. Speak to an expert, speak to someone who has experience in debt restructuring, or speak to some of the government bodies that sometimes assist people in terms of debt restructuring to restructure the debt instead of declaring bankruptcy, to stretch out that period. It would be better to restructure than to be declared bankrupt, because then you're basically not allowed to be a director of any business while you are bankrupt, and you take between 7 to 10 years to get it out. We had an experience where even we had clients that run 50, multi-million businesses, net worth of a couple of million, but he's an discharged bankrupt of more than 15 years. Sometimes the bank just declines, and we are shocked because, he has net worth, his company is strong, he doesn't have much loans, he's borrowing an amount that's even lesser than his listed assets, yet the bank will decline. Because some banks are just more risk adverse. They'll say, well, yeah, he was a discharged bankrupt 15 years ago. And sometimes we argue that, yeah, but that was 15 years ago, it's not relevant now. As you can see, his business is doing well, he has assets that is even more than what he's applying for. Why can't it be approved? They can still decline the application. And one thing that I would like to share is that if you're declined by the banks, there is a possibility you could be blacklisted by that bank for the next 3 to 6 months. And this is based on your ROC number, right? And the reason why banks do that is because they do not believe, it's for practical reason, they do not believe that you will be able to financially have a turnaround within 3 to 6 months to qualify for financing. One thing that people do not realize sometimes is that the bank is still a business. They are in the business of taking cheap deposits and then lending out. That's what they do. They are not in the business of consulting. They will not advise you what to do or what not to do. If you're an unqualified borrower, they will decline application. They'll keep it on record so that they don't need to waste resources to entertain or review the application if you are within that blacklist period. So that's highly possible. And that is why it's important to understand all these factors. It doesn't mean just because the bank reach out to you on a marketing basis, gives you a call, sends you a flyer, you see an online ad, you apply, you will get it. Because you may not get it, and there could be negative effects of not getting it. Not only do you not achieve your objective, you could also end up on the wrong side of the bank, having an unnecessary blacklisted record because you were declined for the application. Next, as I mentioned, you can get your report online from Credit Bureau Singapore website. And then you can see your credit history, you can see your loans. If you take some time to read about it, you can understand like the number of lines, credit lines and credit cards that you have, how does it impact your score. Credit Bureau has all this information, and I think it's vital that you understand all of this because that has a direct impact on your financing approval chances. Next, do not close accounts with debt remaining because this is another factor that harms credit worthiness. Try to pay up debts before closing your accounts. So in summary, ensure that the repayment ability is present when applying for financing. Both company and individual credit factors come into play. First and foremost will be the individual credit factor in terms of your credit bureau score. Ensure that that is passable first before you apply for any business financing. Then you'll move on to the repayment ability of your business in terms of the return checks, in terms of the balances to show that you have the repayment ability, in terms of profitability. Avoid taking on excessive personal credit. So good repayment conduct history provides comfort for lenders. Okay, and that's the end of my presentation. Thank you for your time.
Okay, thanks, Janus. Okay, so this is it. Thank you for both of your presentations and insights. For now, Q&A is still empty. Don't have to be shy. We are behind a computer now, so feel free to type as and when. Oh, there's one. Okay, shall we answer this live? So one attendee asked, is there an ideal strategy or order in which to take loans? So do we take the residential mortgage first, equity gear up, loan second, then corporate term loan third? So I think this is for Janus.
That's a very, very interesting question. You have done some homework. I'm not sure how you derive this strategy. You could have heard some advice from somewhere. But in general, you would be surprised that sometimes lenders would not approve application if you have no credit history, zero. We had applications decline because the owner has zero credit history, never taken a credit card in his life, no loans, nothing, no vehicle loans, no mortgage loans, for example. Why? Because there is no visibility on this person's character. Character being the first layer of assessment. There's no specific strategy per se, but I would say that in general, the credit bureau is a very strong indication of your payment ability or your repayment ability. So if you hover between the AABB level for your credit bureau score, that allows you to clear the first hurdle in terms of getting approval. Then you can focus more on your company business side. So I would say that rule number one is you cannot have no credit. I think it's quite difficult for people in Singapore to have no credit, you know. So have at least something like a credit card, for example. Whatever credit that you have, make sure that it is repaid on time, repaid in full. There's history. Your credit bill report will actually show the rating, like your last 6 or 12 months repayment. If it's like AAA, for example, then obviously you'll be paying on time. Then all this will actually contribute to your overall score. So don't take on excessive credit. Have something on hand at least. Make sure you have the repayment. And then look at your credit bureau report. If you're like AABB or maybe CC, that is still relatively quite safe for you to apply for your bank financing. Yeah. So in terms of strategy, in terms of like gearing up, balance transfer, I don't have the specific answer for you, but it doesn't matter. It all culminates back to the same point that your credit bureau overall score is the most important factor.
All right, thank you, Janus. There is another question, I guess, for you again. So for the prior question about loans, assume there's a strong AA credit rating with good payment history in the past 10 years. This is the question, but I assume he or she means that will he still be able to get the loans even if a strong AA credit rating?
Okay, so in general, that is ideal with a good credit bureau score and with good repayment records for both individual and both on a company level. But do take note that there are also instances where some banks may not entertain applications for industries that they want to have lesser exposure to. There is no way to find out this information. I mean, in our course of work, we know. But in general, if you are self-applying, it would be safe or prudent to ask the assigned banker before you submit any documents is your industry an avoided industry for that particular lender? This is information that they would tell you out of goodwill. It's not official. No bank will advertise on their website and say, we're not entertaining applications from this industry. They tell you, yeah, we'll look at it case-to-case basis. But if you are in an industry that is avoided by the lender now, then it don't make sense for you to try your luck to apply with that bank, right? Because you can get declined, and it's not your fault. It's just a general industry exclusion. It's an internal thing that sometimes they do, and then they say, hey, you know what? We're gonna hold back all applications from this industry, for example. That could delay your application process, or they may say, let's just decline all the loans that are from this industry in general. That could happen. And when that happens, then you end up with that record of being blacklisted possibly, or that you have a record of being declined by the bank for this particular application. So other than that, I think in general, based on the bank statements, the return checks that I mentioned about, the credit bureau score, your personal credit bureau rating, and to ultimately check with the lender whether the banker whether is your industry acceptable or favorable to that particular lender that that will be prudent. I mean, it's just extra step that you might want to consider taking to us. It is, and this is also to determine to a certain extent whether the assigned banker that is on your case, on your application, is experienced or not. If you're not sure, you can always feel free to reach out to us for further insights on this matter.
Okay, thanks, Janus. Next on, we have a question for Julia. So Julia, based on your experience, what are the other sources of financing available if the banks have rejected me?
If the banks reject me, I think outside, well, there are other institutes, they do provide funding for that. I mean, there are crowdfundings, so of course there are interest and administrative, they will have much higher interest rate involved. And they also claim that the turnaround times and all this are much faster than the bank. So, well, you can try that if you are so-called desperate. And also, well, I think in a way, depending on your business model, whether your confidence to raise some investment for your business, so that will be another way of equity fundraising. So, but that is something that you have to consider carefully, because bank loan is a bit more strict. Certainly, it's a bit more straightforward, you know, without involving the equity side of it. So, yeah, this is something that I think there are institutes outside. They do provide short-term fundings and all this. Janus, you have something to add?
Yeah, just to additionally add, there are institutions that also can lend against the e-wallets. We have found this out recently. You can check with the non-bank institutions. In the past, they used to do this merchant cash advance where they will put the NETS terminal for the business, and then the lender will lend you based on the takings, and then you will repay using their terminal to make the repayment. So if your collection in the past using your NETS terminal, if your collection on a daily basis is, let's say, $5,000, then they'll calculate and take a portion of that payment made through the NETS terminal to deduct for the daily repayment of the loans. Now, the e-payment wallet, which is like your GrabPay, your FavePay, e-wallets that are used to make payments to the merchants, maybe for example your Grab delivery and Deliveroo, whatever apps that you're using to make that payment, has now become the modern version of the merchant cash advance. So what some funders may possibly provide is that they can fund you against the collection from your e-wallets taking. Because how it works, what I understand is that for F&B, when you get your payments from Grab and FavePay, it's typically not immediate. So if someone pays today using that, then it takes a day or two or something like that before the payment comes in. So what happens is the funder would then control that account. They will speak to Grab or Fave, control that account, review the cash within that takings on the monthly basis, for example, for the last 6 months, 1 year. They will then approximate a loan that they think is comfortable for you to repay based on your history. And then they will deduct a portion as loan repayment on a daily, weekly basis, for example, and then transferring the balance back to you. That means the payment goes from consumer to e-wallet, funder repayment, and then back to the F&B operator. So that's also another option. And why this option is good? Because there's room for negotiation in the case of maybe your volumes get decline in terms of the takings. Then you can still negotiate with the lender, because hey, there's visibility, right? This amount is my takings, and it's gone up, it's gone down. We can adjust your repayment accordingly. And another good thing that's also important is that the lender may possibly not take into account your existing loan obligations, because this is actually a charge on your receivables in that sense, and they are the first to be paid above all your other lenders in that sense. So this is a solution that you can look into and maybe speak to some of the institutions and see if they offer this. I'm talking about non-banks, that is.
Okay. Thanks, Julia. Thanks, Janus. I think we have enough time for one last question. I know all of you are behind a keyboard, so you can choose to be anonymous, but it'd be good if you can have some names. So perhaps we could follow up right after this session individually. Okay, so the question is, if the company last year P&L made a loss, does it mean that the company should not bother to apply under the TBL? I would assume will be the temporary bridging loan scheme, even if the government is taking on higher risk. So even if the director's personal credit standing are good. Then he has also another added on question would be, the company performance actually improved few months before the circuit breaker, but it hasn't shown yet because it's not the financial reporting period.
I guess this question is for me, right? Okay. Yeah. I shall not reveal which lender, but there are lenders that can access, I talk about banks, yeah. There are lenders that can access the TPL and WCL, which is the working capital loan applicate assessment, without the need for financial statements. I just kind of revealed a secret, but so don't quote me on it. But there are lenders, I repeat, that will assess without the need for financial statements. They only look at your credit bureau. They only look at your bank statements. So how do you know? When you check with the various lenders that are facilitating this scheme, check that and find out whether you need to submit your financial statements. If you don't need to submit your financial statements, you have passed the hurdle of not being profitable. So earlier on, whatever I touched upon in my slides is in general. That's the most ideal situation, but it's not possible to be ideal or perfect all the time. So if you see that the lender does not require the financial statements, then the factors which I described earlier about the bank balances, about your credit bureau score, will put you in a higher chance to get approval.
Okay, all right. I guess just nice. We have hit the 1 hour mark. So once again, thank you for attendees for coming, logging in, and also like to thank Ms. Julia Kwok and Mr. Janus Lim respectively. So I'll be sending all of you your PowerPoint slides.
There's one last question.
Oh. Okay, shall we do this? Since MAS has mentioned they are lending to banks at 0.1%, so how is the banks lending at a rate of 2 to 3%?
Banks have costs. Their RMs are expensive, their branches are expensive, they send you expensive promotional materials, they do very expensive advertisements, they have their costs. The truth is, this is national service on the bank's part. What people don't understand, I'll take this chance to answer a bit more so that to clear up some misconceptions. We have heard from the ground about, like, for example, this cheap funding and the fact that the government is covering 90%. So I'll take this opportunity to clear up some misconceptions. One is that the capital still comes from the banks. No bank would want to take on an unqualified borrower just because the bank has insured against the default. And the 90% risk sharing only kicks in, let's say in the event of a loan default. The guarantors will still be chased first by the banks. The bank does not absolve the guarantors of the default just because they have covered 90% of the risk. So what will happen is that the banks would chase the guarantor first, and if they cannot recover the full sum, then the government will step in with the repayment. That's what I understand. That's why you sign a personal guarantor. Okay, so it's not that the bank will not chase you. So do take note that this is a loan. It is not a grant, whereby if you don't pay, the government will take care of it on a 90% level, or you only need to pay back 10%, for example. That is not true. As for the cost of funding, which is from the government, the bank has reduced one of the lowest rates that we know in history. It has never been this low for quantums this large. So it will not be possible for a bank to lend out close to whatever they borrowed at. This is more on the government side to encourage the bank to try to make more available capital. But from a business perspective, no bank will take on a financially unviable borrower, because no bank wants to end up with a non-performing loan, the borrower not paying, and then they have loans that they need to chase back. Then they got to go through the process of suing you for bankruptcy to recover the amount, then going back to the government for the balance. It's a very long process. The banks are not keen to do that. They would rather just deal with companies that are qualified. Having said that, if you are qualified, we have seen on instances where you may be able to qualify for more than what you normally should or could in normal circumstances. So in simple terms, the summary is that if you are not qualified, you will not qualify. They're not going to lessen or loosen the criteria just because of this risk sharing. But if you're qualified, it could be possible that you could qualify for a slightly larger amount, case-to-case basis. And our personal take is that our advice is that if you decide to continue your business, then try to work out what's your cash flow requirements as mentioned by Julia. to calculate your burn rate for at least 1 year, and then to take the financing to last 1 year without revenue. If you can access to that funding where you can last for a year, then I would say that there's no risk because the cost is so cheap, the processing fee is so cheap. In some cases, I think it's waived, and there is no repayment penalty. So if I'm a business owner, and what we have personally advised our clients is that take the money, roll first. You know, you may not use the whole sum, right? Because it's going to last you for 1 year. We don't expect it. Hopefully, it does not. You know, this COVID is not going to last for 1 year, right? So if you prudently take for 1 year as a buffer, whatever you use, you have already paid down in terms of installment, and the balance you can make repayment to the lender with no prepayment penalty. So I think that is the most logical, smartest financial decision that you can make if you are qualified for the loans.
Okay. All right. Thanks all. So I guess the questions are good. Hope the answers are good as well. Anyway, I'll send the survey form together with the slides. So if there are still any burning questions, feel free to leave them on and we will get back to you accordingly. So, okay. Thanks again. I think this is it. Stay safe, everyone. We hope to see you this Friday for our next session on Landscape of Government Grants 2020 by SME Center. All right, then. Thank you all.
Bye.
Bye-bye.